Last week, we saw a lot of volatility in the market, which wasn't helped by the large earnings week that we had, and this in turn has left investors feeling fear, as we can see right now sitting at a score of 39. Not too long ago, we were sitting in neutral, and if we remember that famous quote from Warren Buffett, "Be fearful when others are greedy, but greedy when others are fearful." So today we're looking at 4 undervalued stocks that we consider to be a strong buy. The first one is Intuit, a financial software company that provides tools for personal finance, accounting, tax preparation, and they're very well known for their products including TurboTax, QuickBooks, and Mint, and they aim to essentially simplify financial management for individuals as well as small businesses. We also want to show you their income streams. As we can see, the large bulk of it is made up of both the QuickBooks, MailChimp, as well as their TurboTax, with some very high margins, in fact 56% and 76%. This is definitely something to take note of. Now, the company itself is down around 10% over the last year, but over the last 10 years, it has massively outperformed the S&P, up 543%. Right now, it is trading pretty much near its 52-week low with a buy rating from Wall Street. It does also pay a dividend, which currently yields around 0.72%. And if we are to take a look at their earnings, first thing we will point out is that over the last 4 quarters, they have outperformed every single one against management targets, 100% track record, and out of the next 4 quarters, they anticipate 3 of them to be growth, and those 3 they are expecting double digit. In terms of their forward P, well, if we look towards July 2025, based on the earnings per share of 19.29, it currently sits at the 30 mark, and whilst they do get an F on the valuation, we can see it does sit above the sector median of 25.5, around 18% right now, but bear in mind, some companies do deserve a premium. We need to understand whether or not Intuit is one of those, and we believe the answer is yes. We can also note their 5-year average does sit just under 39, which right now means it's trading 22% below. But as always, here are the different valuation metrics for those that do prefer to get a gauge, not just on the forward P, but others like the price to book, price to cash flow, EV to sales, and many others. In terms of the growth, they get a C+. Now, both year on year as well as on a forward-looking basis, it sits between 12 to 13%, which is both respectively above the sector median at 4.8 and 6. However, it does come in lower than their 5-year numbers of 19.5 and 15.7. One thing we do, however, like is the earnings per share projected to grow at 20% year on year over the next 3 to 5 years, which is above the sector comparative of 15, as well as their historical average of 16.4. Profitability looking very impressive at an A+. As we said, their margins are very, very strong, 80% on the gross margin line, above the sector at 50, not far off their 5-year of 81, and their bottom line at around 18%, significantly higher than the sector, and the same to be said, not far off their 19.4 of the 5-year, and they do generate a significant amount of cash from operations, 5.3 billion, well above the 104 million of the sector, and also quite some way above what we have seen over the last 5 years at 3.8 billion. Now, for each one, we will also get to the valuation, but we want to highlight the quality of these companies. Now, we can see dividend safety, very safe. We'll cover these 2 valuation metrics shortly, but very nice to note, something consistent with this company, a double-digit increase of 16% in August last year. Now, it was reaffirmed just a few months ago, very safe score, which ultimately means a dividend cut for Intuit is highly unlikely. In terms of key metrics, this is from the 07-09 recession. They didn't pay a dividend, so no comparative data. They had plus 1% sales, which was above the average of the S&P, in fact negative 12, and their return, whilst negative 29, did outperform the S&P's negative 55. As we mentioned, very consistent with this company to offer double-digit increases to their dividend year on year, sitting at 17% on average over the last 10, and we can in fact note here they have been paying an increase to the dividend on a consecutive basis for the last 12 years. So first valuation model we're going to get into is the forward P. Bear in mind, we're not looking at any one of these models in isolation. We will get it through our own model shortly. But what this blue tunnel indicates is the expected fair price. Right now, it sits even lower than the bottom end. This is one case here of severe undervaluation. And we can also note by looking at dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, another undervaluation signal. as well as one we've already briefly mentioned, that the forward PE 29 sits below their 5-year rolling of 34. We have already mentioned this company does trade at a premium, but we do believe it deserves one. Again, we want to understand as we get to our own valuation, how much and what kind of margin of safety are we talking about. In terms of free cash flow, as always, that is what we focus over the earnings, which is susceptible to manipulation by management through accounting. Below 60% for the payout, we see that consistently and expected over the next 12 months. No surprises then why they can offer those double-digit increases. And free cash flow per share, we want to see consistent increases over the longer term, pretty much quadrupled from 2015, expected to go even higher over the next 12 months. This is what we want to see from very high quality companies, and actually there aren't that many companies like Intuit that can pull that off on a consistent basis. In terms of sales growth, well, nearly double digit every single year, and that is significantly higher than the minimum we want to see, 3 to 4% at least, just to keep up in line with inflation. We can see the growth of their top line sales quadrupled from 2015 to 2024, and whilst we do like companies that return excess cash through those share buybacks, Intuit haven't really done that. In fact, from around 2018, they have been diluting your position, but very minimal, as we can see, pretty much a trivial movement from 2015 to where we are sitting today. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Now, we have noticed it has started to decrease, yet right now sits around 15%, which is still very strong. As we said, minimum 10% is what we want to note. And both operating margin above the 12% minimum, same to be said for the free cash flow. Some very impressive numbers. We do like this a lot. In fact, you could call this a free cash flow machine. Then we get to the final metric, equally as impressive as the others, the net debt to EBITDA. We want below 3. Numbers you can see below, number of years it would take the company to pay off all of their debt, net of cash on hand. 0.51 on a trailing 12 month, expected to go lower over the next 12. So this signals to us, no surprises, how the dividend score does look to be very safe, and also reflecting that the balance sheet does look to be strong. As we said, each one of these companies, we are going to run through the valuation. Now, typically on the channel, we do our deeper dives. We run through every single one. Today, we're getting straight to it, where we are in fact going to look at the intrinsic value, which is just the average of these three, 766. We're not done just there because we do always start off with a margin of safety, kicking off at 10%, executing on that if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at around $690, then we keep going till it's near the current trading price. Not at 30% just yet, but it is sitting around the 25% mark. If you can get this around $575. Wall Street themselves, with the buy rating, they have a price target of 736 by the end of 2025. This translates to 27% upside, but as always, give us your thoughts below. Is Intuit one you're considering, maybe on your watch list, or for whatever reason, even if it isn't one for your portfolio, give us your thoughts below. We also want to let you know we have released our latest free weekly article. We draw on every single Monday morning, where we highlight severely undervalued stocks, as well as what's gone in the market over the last few days. So as we are dropping a new copy tomorrow, don't forget to sign up, click on the pinned comment, and you can read previous articles straight away. You'll also be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the next company, that is Microsoft, the global tech that develops software, electronics, and cloud services, best known for its Windows operating system, Office software suite, as well as the Azure cloud platform, and their products and services cater to both consumers and businesses, aiming to enhance productivity as well as digital transformation. If we just take a look at the company, the way they generate their top line, we can see it is quite a mix between Microsoft 365 and the cloud, taking up a large portion with some very impressive margins. These are on the operating side at around 57% and 42% respectively. If we get to the company, well, it's pretty much flat over the last 12 months, negative 1%. Over the last 10 years, another massive outperformance of the S&P, up 834. Right now, trading towards the lower end of the 52-week range. A strong buy from Wall Street, as well as a buy from Seeking Alpha. And similar to Intuit, it does pay a dividend, although on the lower end at 0.81%. In terms of their earnings, well, green right across the board. anticipating growth every single quarter over the next 4, 100% historical track record, and based on the June 2025 EPS, the forward P right now sits at 31.13. If we do then compare that in terms of others in the sector, again, very similar to the previous stock, it does trade at a 22% premium to the sector comparative, but it pretty much trades not far off their 5-year average, and as you can see, depending on the different valuation, you will get some different information. If we take a look at their growth, they do get a C, however, year-on-year revenue and over the next 12 months in the 14-15% region, above the sector around 5 and 6 respectively, and also marginally above their own 5-year average of 14 and 13%. Where this company does get a little bit let down, hence the C overall grade, is the EPS expected over the next 3 to 5 years at 13%, which is marginally lower than the sector, but pretty much in line with their 5-year average. In terms of profitability, A+, very difficult to beat in this sector, 70% gross margin, above the sector comparative, slightly higher than their 5-year average. Bottom line looking very good, 35% above the sector by a massive distance, pretty much in line with their own historical figures, and cash generated from operations, a huge amount, one of the most in the Mag 7, 126 billion, significantly higher than the 104 million and the 85 billion from their own previous data. If we take a look at the company, another very safe dividend score, getting through to these valuations shortly, but again, similar to Intuit, this is a company that historically increases their dividend at a double-digit rate, and it was reaffirmed a few months ago that the dividend cut is highly unlikely. Bear in mind, in the last recession, they maintained the dividend, they didn't increase or cut it, they had around the average growth and not far off the S&P's return at negative 48%. As we said, this company does increase the dividend at a double-digit rate, in fact 16% on average over the last 20 years, and they've been increasing it consecutively for the last 14. If we take a look at the first valuation, we can in fact see, zooming into the last 12 months, right now it is trading towards the lower end of the blue tunnel, so it does look to be like some kind of undervaluation. In terms of dividend yield theory and the forward PE, you could argue here both of them not far off their 5-year average, so a possible reasonable signal, and as already highlighted, it does trade quite some way away above the information technology sector as a whole. Free cash flow payout, no surprise again for a company that, like Intuit, does pay double-digit increases, sitting around 34% on a trailing 12-month. The free cash flow also very attractive, more than tripled over the last 10 years, expected to continue over the next 12 months. And their sales growth nearly double-digit every single year, especially for the more recent period, 16% in 2024 alone. And their total sales, no surprises here, very large growth, more than double. One thing that they do that we didn't see from Intuit is share buybacks, maybe not on a consistent basis, maybe a little bit too trivial, but nice to see on top of the dividend increase, one way this company is returning that excess cash and using their capital allocation. ROIC, absolutely no complaints whatsoever, 29% on a trailing 12-month. And one thing that maybe we didn't identify from the previous company is on the operating margin, the efficiencies, not only increasing their revenue, but their margin has gone up from 30% to now sitting at 45%, and another what we would call free cash flow machine. Net debt to EBITDA, absolutely phenomenal as well. These first two companies, very strong on the balance sheet. It wouldn't take them that long to pay off all of their debt, net of cash on hand. Jumping into the valuation, we get $494 today, derived from the DCF model. Now we can show you this one. We have the updated free cash flow numbers. Average growth around 14%. We have gone a little bit higher in line with analyst expectations. Now you can see a low, medium and high rate here. These numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below. But with the medium 16% and the discount rate, we get the present value of the future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. As we can see, 494 indicating 21% upside. For full transparency though, for those that believe 14% maybe is more appropriate, $430, 5% upside, and at the higher end for the more optimistic among us, we can see 5, 6, 7, 39%. Now if we do take that 16% and apply the standard 10% margin of safety, we can see a buy at around 445, at 15% around 420, at the 20% point around 396, which we do believe is a very good opportunity around the 396 point, with Wall Street, as we mentioned earlier, a buy rating $511 and they see 25% over the 12 months. We then move on to ExxonMobil, the multinational oil and gas company involved in the exploration, production, refining and marketing of energy products. It is one of the world's largest publicly traded companies with operations spanning across the globe and also investing in developing alternative energy solutions as well as technologies. In terms of the company, it is up around 7% over the last year, and over the last 10 years, it has underperformed the S&P, up around 17%, but bear in mind, it will depend at which point you bought. For example, if you did buy the COVID lows at around the $32 mark, you would be up quite significantly right now. As we can see, another one trading towards their 52-week low, a strong buy from Quant, a double buy from Seeking Alpha on Wall Street, and with a fairly attractive starting yield of 3.64%. If we take a look, bear in mind this is a cyclical industry. We do notice out of the next 4 quarters, only 2 of them to be growth, with a 75% historical track record. In terms of the forward P right now, it does sit just above the 15 mark, and if we do compare this against others, it is trading like the previous 2 companies at a premium of around 28%, but isn't that far off their own 5-year average, and we can see here pretty much a similar conclusion across the other metrics. If we take a look at their growth, a C-, now revenue year on year and forward looking pretty much around the 1% point, which isn't too far off the sector itself, but we can see the previous 5 years have been a lot better with the averages between 8 to 4%. In terms of the EPS over the longer term though, 8% is anticipated, which is marginally higher than the sector, but actually quite significantly above what we have seen from them on a historical basis. Profitability, A+, gross margin 30%, below the sector but not far off their own 5-year. Bottom line around 10%, not far off the sector but actually quite some way away above their 5-year average. And the cash this company generates from operations significantly above the sector, 55 versus 576 million, but also actually quite some way away above their own numbers of 46.63 billion. In terms of the company, well, they get an 80 score safe on the dividend, which looks to be very good, and they did increase the dividend last November at 4.2%, which is pretty much in line with the average inflation rate. So what does a safe score mean as opposed to a very safe? Well, we have here a dividend cut is unlikely. When we take a look at the company from the last recession, they actually increased the dividend. They had below average growth quite significantly, but they actually massively outperformed the S&P, negative 28% return. And whilst we did see an above inflationary increase in November, over the last 5 years, it has been below. However, if we expand to over the last 20 years, it sits at the 7% point. And this company is a dividend aristocrat, 25 plus years of consecutively increasing. However, they've been paying a dividend for the last 143 years without a reduction. In terms of looking at the company on the valuation spectrum, we can see quite some way away. According to this model, it has been trading overvalued. Right now, though, it is sitting within the blue bucket, which does indicate reasonable signal. If we were to take a look at dividend yield theory as well as the forward PE, given where they sit, this would be a slight overvaluation signal. And according to here right now, this company trades not far off the sector at around 14.7. If we were to take a look at the free cash flow payout, below 40% for oil producers, something we see there or thereabouts over the last few years. Bear in mind though, cyclicality in this company will sharpen the numbers, hence we can see the free cash flow, not consistent growth, some years very strong, some years very poor, and over the next 12 months a marginal increase is anticipated, and cyclicality shining right through the sales growth. In fact, when we look at the last 10 years, 5 of them have been negative, and it's a lot clearer when you look at it based on a numerical format. In terms of shares outstanding as well, they have marginally diluted your position if you've been a shareholder in 2015, 4.2 billion, now sitting at 4.3. In terms of the ROIC, again, lots of inconsistency. Right now though, pretty decent at the 13% point, and the operating margin and free cash flow margin really highlighting here the cyclicality, although above 12% at least the last 3 years, and the free cash flow margin has been above the minimum since 2021. Net debt to EBITDA below 1.5 for oil producers. Very nice to see it has been below that from 2021. 0.3 over the next 12 months. So balance sheet looks good. And as we saw above, dividend safety sits at the 80 mark. In terms of the valuation, $122 is where we get to today. At a 10% margin of safety is pretty much around where we see this company. In terms of Wall Street, they say a buy with $134 price target, upside of 23%. For those that want 15% MOS, around the $104 mark, at 20% around 98. But right now, 10% MOS, this is a company that has been paying a dividend for a very long time, well over 100 years. The yield does look fairly attractive now. Let us know, is it time to start considering oil and gas companies? ExxonMobil definitely is one that should be for consideration. We then move on to PepsiCo, the global food and beverage company known for its wide range of products including Pepsi, Mountain Dew, Gatorade, Lay's and Quakers, and the company manufactures, markets and distributes snacks, soft drinks, other convenience foods, and they focus on delivering sustainable growth as well as creating healthier product options. We can also see from one of their latest quarters the large bulk of their revenue does in fact come from PepsiCo beverages, but coming in second we do see the Frito-Lay, which is quite a large chunk, sitting around 5.9 billion. The company hasn't had the best of the last 12 months, down around 16%. Over the last 10 years though, up around 46%. Bear in mind that has underperformed the S&P, right now pretty much sitting right near its 52-week low, but both Seeking Alpha and Wall Street consider this company a buy, with a yield near the 4% point at 3.75. If we take a look at their earnings, they expect 3 of the next 4 to be positive, but very consistently with this company have outperformed over the last 4, and their forward PE right now, based on the EPS for 2025, sits at 17.37. Valuation grade, they get a C. It is above the sector, but only marginally at 9.14. The key takeaway here, their 5-year average forward P sits at 23.9. Right now, it sits 27% below that number. In terms of the growth, they get a C-, not looking too great, around the 1 to 2% point year on year and forward looking, which is pretty much around the same as the sector median, but quite some way away from their own 5-year averages that sit around the 5 to 7% point. And we do see a D+ on the earnings per share. They only anticipate here 5% growth year on year, below both sector as well as their 5-year, which does hover around the 7 to 8% point. In terms of profitability, they get an A+. Gross margin looking very good, 55, above the sector at 36, pretty much in line with their own historical data. Bottom line, 10.43%, again the same conclusions to be drawn, above the sector, in line with their 5-year, but their cash from operations does steal the show, 12.51 billion, above the 817 of the sector, and also above their own comparative of 11.29. This company also has a very safe dividend score at 93, and they did just increase the dividend this month at a 5% point, which is above the inflation, as we say, at 4%. When we take a look, again, a very safe dividend in terms of reaffirmation on October last year, and if we were to look at their key metrics, they increased it during the last recession, pretty much flat during the recession, but also outperformed the S&P, negative 35% return. Over the last 5 years, dividend up 7%. Over the last 20 though, nice to see double digit. And for those that don't know, PepsiCo is in fact a dividend king. They've increased their dividend for the last 51 years. If we take a look at the first valuation, when we do zoom into the last 12 months, we actually see massive disparity between the lower end of the blue tunnel as well as where it sits right now. That is a massive undervaluation signal, and we can also see, in fact, the yield is nearly touching the 4% point, the highest offered over the last 5 years. Massive disparity, massive undervaluation, the same to be said for their forward P, and as we highlighted, it isn't too far off their own consumer staples sector at 17.3. If we look at the free cash flow, maybe one of the negatives of this company is that on a trailing 12 month and in 2024, they paid out more in dividends than they generated in free cash flow. The only positive to take here is that over the next 12 months, it is expected to come down to 73%. Definitely something we will be closely looking at during the next quarter report, as well as their annual accounts that do get released. Free cash flow, very inconsistent, not much growth on a year-on-year basis, although expected a large movement over the next 12 months, but always have realistic expectations. Of course, a company like PepsiCo isn't going to have the same growth that we see from the Mag 7. In terms of the sales growth itself on a percentage basis, not looking good in 2024. That is not just a 0%, but remember, if companies aren't at least increasing by 3 to 4%, that is below the inflation rate, so in real terms, it is decreasing. And we can clearly see on the numerical format, they've increased their revenue around 50% over the last 10 years, with some share buybacks, but again, very, very trivial, probably not something we would incorporate into investment thesis. ROIC though, very consistent, very strong, sitting at 21% on a trailing 12 month. That is good to see. And the same to be said with the operating margin, straddling around the minimum we want to see. No efficiencies, but consistently around the 16% point, and no complaints on the free cash flow above our 7% minimum. In terms of net debt to EBITDA, as we saw above, a very safe dividend score, not only below 4, but from 2020 has been decreasing, now sitting at 1.99, which is always a good sign, definitely something to incorporate when you look at companies. And in terms of our updated intrinsic value based on the release of their earnings, we get to $173, which when we do take a look at this valuation at 15%, a buy up to 147, at 20%, around 138, 139 could be a great opportunity to buy this Dividend King with a yield that will be slightly above the 4% point. Right now though, around 15% at 147, and Wall Street, even with their buy rating, they see this at 167 by the end of the year. That is upside of 16%. And as always, do give us your thoughts in the comments below, whether you're adding to any of these, maybe you're holding, or for whatever reason they just don't fit your overall portfolio. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets. We are dropping a new copy tomorrow morning, and come and join us in a Patreon where we do cover our weekly buys and sells. In fact, we have been buying and selling over the last few weeks given the volatility. As always though, have a great day, and we'll see you all on the next one.